on the Bloomberg terminal. And of course, we will be sorting through those Brexit deal details, even as hopefully most British viewers are sound asleep on today's holiday. Coming up, relief at last in America. President Trump signs off on the $900 billion virus aid bill, but still demands stimulus payments be raised to $2,000.
Have you or people you know owned a Volkswagen, Audi, Skoda or Seat diesel?
Welcome back to Bloomberg Markets. This is the European Open. We are 50 minutes away from trade here on the continent, of course, over in the UK, as I guess compensation for the Boxing Day holiday, which was on Saturday. There will be no trading on this Monday. Let's get the Bloomberg business flash news. These are today's top corporate stories from the Bloomberg terminal. BMW planning to build an additional 250,000 electric cars over the next 3 years. This, according to an interview with the automaker's CEO. Oliver Zipse says sales of electric vehicles will account for about a fifth of BMW's car sales in 2023. That's up from 8% right now. But he is concerned that Germany's transition to e-cars may be hampered by a lack of charging infrastructure. And I can tell you that it is sorely lacking. Billionaire Elon Musk says it would be impossible to take Tesla private at this point. The comment came in response to a tweet calling on him to spend more time on innovation. Tesla shares have of course surged this year, actually 8 times higher than they were at the beginning of January, ahead of the company's addition to the S&P 500. That's twice the advance of the next best performer on the index. So a big gap between number 1 and number 2. And Deutsche Lufthansa has cut costs more quickly than expected this year. The German airline's boss says the company is not in danger of slipping too far into debt. He told a German newspaper the airline has about 10 billion euros of available liquidity, and it's only tapped a third of the 9 billion euro loan it got from European governments. Hasn't spent much of that rescue loan then at all. And that's your Bloomberg Business Flash. Now, as we told you before the break, and you probably know if you're awake, President Trump has signed a bill containing $900 billion in pandemic relief. That avoids a government shutdown and avoids delays to the coronavirus aid package. While signing off on the deal late last night, Trump demanded a vote in Congress to increase $600 stimulus checks to $2,000, a demand that he has put out there on Twitter for a while now, but it's unlikely to pass both chambers. And interestingly enough, he squares off with that demand against his own Republican base. Let's get more with Bloomberg's Bruce Einhorn. Bruce, this is interesting. We see Trump at odds with Republicans calling for larger stimulus checks. He didn't get them in the bill, but he decided to sign it anyway. Finally, what's changed?
Nothing's changed. The bill that he called a disgrace last week is the same bill that he's just signed. So he has issued a statement saying that he's insisting that Congress remove funds that he says are wasteful. He says he's sending this strong message. But, that's not how the U.S. system works. Once he signed it, he doesn't get a chance to tell them, all right, you have to make these changes. He signed it. It's a bill. I mean, it's a law. It's done.
So let's talk for a moment about what I think two interesting things are in Washington right now. The Republicans don't want to give him, it's almost like Trump Pelosi teamed up for this $2,000 stimulus checks. The Republicans don't want to give it to him. And then even more interesting, I find, Trump wants to take away protections from these social media giants, these huge corporations for what users post on the sites. And the Democrats seem to not want to take those protections away from these giant corporations. What am I missing here?
Well, that's one of the reasons that Trump gave for vetoing the Defense Authorization Act, which it seems that both houses are ready to override. And I think what Trump is now saying is he wants, at the same time that Congress approves a separate bill that would increase payments, that they would maybe wrap in this thing about social media in that as well. I mean, it's not going anywhere. I think it's pretty safe to say, between the Republicans being opposed to the additional relief payments and the Democrats being opposed to changes to social media. It seems like this is a lot of talk, but there's not going to be any action.
All right, well, never a dull day, at least in Washington. Bruce Einhorn, thanks so much for joining us with the latest on U.S. politics, which actually seems to drive risk sentiment around the world. We're joined now by RICARDO Evangelista. He's a senior analyst at Active Trades. And RICARDO, it does seem as though the stimulus package is going to set up risk sentiment for us here in Europe. It certainly seems to have done that in Asia. How important is the U.S. economy to global markets?
Good morning, Matt. The U.S. economy is very important for global markets. The markets at the moment are sustained by the sentiments of investors that are very, very open to risk, much more than they've been, say, for example, back in March. So as the political developments in Washington unfold in a favorable way to this sentiment, the markets are likely to display and reflect that sentiment. Today, of course, we have somehow less so of an effect because many traders are away and it's a holiday in some places as well. But I think this is a very positive development for the European and global markets.
Right, it's a holiday in the UK today, but still, you'd think the Brexit deal would be more important to European markets than stimulus. It doesn't seem to be. It doesn't seem to have much of an effect on, well, certainly not on continental assets, and we haven't seen much playing through in the pound. What do you make of this Brexit deal?
Well, the Brexit deal that we ended up with was, to a large extent, already baked into the price of the pounds, and it had already been digested by most investors. The process dragged on for 4.5 years, so there was a lot of time, many ups and downs, and very tough negotiations. with a lot of posturing from both sides, a certain degree of brinkmanship as well. But essentially, what we ended up with, it's considerably less than what we had before. So this is a trade deal that provides some positive developments because there are no tariffs on goods and there will be no quotas on goods. But there are many other aspects of the economic relationship between the continent and the UK that are not covered by this agreement. So I would say that it was perhaps the less bad of the options on the table, but it is nothing worth celebrating. And that's why you're seeing that there is some upside for UK assets and European assets, but this upside is very limited by the limited scope of the agreement, and it reflects only the end of the extreme uncertainty we lived with for the last 4.5 years.
When you look at, Ricardo, U.S. assets, European assets, Asian assets, what's your pick for 2021? Where should investors be putting their money regionally?
Well, I think 2021 will, maybe I'm an optimist, but I believe that 2021 will continue to carry on this positive momentum. I believe European assets are perhaps underpriced comparatively, for example, to American assets. Although the composition of, for example, American stock indexes will also dictate a positive return. I would say that European assets probably at this stage will be more attractive than American assets, and elsewhere in the world, if we look, for example, at emerging economies assets as well, there will be some very good investment opportunities, assuming, of course, that this positivity remains the prevailing spirit in the markets.
All right, Ricardo, there's a lot more to talk about with you. We're going to keep you around. Ricardo Evangelista from Active Trade stays with us. Coming up, the EU is 24 hours into its vaccination campaign. This as the UK looks poised to approve AstraZeneca's vaccine for a bigger boost. The latest on the battle against coronavirus. This is Bloomberg. Welcome back to Bloomberg Markets. This is the European Open. We are just about 37 minutes away from the start of cash trading across Europe. Remember, the UK is closed today for the Boxing Day holiday. Now, the European Union has begun vaccinating against COVID-19. That's as governments struggle with a continued rise in the number of people infected and killed by the virus. The bloc's rollout comes weeks after the U.S. and the U.K. began their own vaccination programs. Let's get back to RICARDO Evangelista from Active Trade, still with us. RICARDO, what do you think this means for European risk assets?
It's great news, obviously. I mean, the vaccine came at a crucial point. I mean, imagine what the scenario would be like if there were no vaccines. So having success on that front has been fundamental to increase the risk appetite in Europe. The situation in several countries across the continent is still serious, of course, and things may even get worse before they get better, especially now with the Christmas holidays and families getting together and people traveling maybe more than it would be advisable. It's likely that the numbers will rise. However, in terms of the sentiment of investors, it's more likely to be driven by the expectation of the brighter days ahead that the vaccine brings than by looking at the present and the actual numbers.
So, but we see such a disparity, RICARDO, in assets across the Atlantic, with the S&P 500 up 15% year to date, the IBEX 35 down 15% year to date. Is a weakening dollar and a strengthening euro, as well as the rollout of vaccines across a region that sorely needs it, going to help those equity indexes here in Europe to recover?
Well, absolutely, it will help, but I think there are other structural reasons, as you know, for the discrepancy in performance between equities on one side of the Atlantic and the other. If you look at the composition of the main American indexes and what's behind the very successful 2020 that we've had, you see that it's been driven mainly by the tech sector, or to a very large extent by the tech sector, while in Europe there is no such thing as a tech sector, at least in terms of what we find on the other side of the Atlantic. And also Europe has been suffering quite a lot with the impact the coronavirus had on traveling, on tourism. And you mentioned the IBEX there, and in Spain we all know that it's an economy that is to a very large extent dominated by tourism, and so it suffered severely the effects of the confinements and the coronavirus. So I would say that yes, it will help, but what will really help will be the end of the pandemic.
Well, absolutely. Hopefully these vaccines work well and I can get back to Asturias as fast as possible. RICARDO, thanks so much for joining us. RICARDO Evangelista, senior analyst at Active Trades, talking to us about markets on both sides of the Atlantic. Coming up, Chinese regulators ask Ant to return to its payments roots and overhaul its entire business model. What does this increased regulatory scrutiny mean for the company and the market? This is Bloomberg.